Well, welcome everyone to the IHDA Access Program, how to get your clients up to $10,000 in down payment assistance and or closing costs, which really is going to help them to become homeowners. It's going to make homeownership that much easier. I start with this and I'm going to end with this handout, because what I want you to do is think as you're hearing and you're listening today. Is this something that I would like to be carrying around in my briefcase? Would I like it in a folder with your picture? Notice down here, it's got Jake Kilt's picture from HomeSmart. It's got his logo. It's got his contact information. And what it allows Jake to do, and what it allows you to do, is that when we go through and we educate you on what these three programs are, the $6,000 program, and then there's the $7,500 program, and there's the $10,000 program. It allows you to pull it out of your briefcase, hand it to someone, and say, if you're thinking about, becoming a homeowner, I want you to know there's options for you. There's options up to $10,000 that I, as a realtor, and my team can provide to you to help you retain up to $10,000 of your own funds. Possibly they don't even have those funds to retain, but now all of a sudden it gives them that dream of home ownership. I mean, when you don't have the necessary funds, you don't dream of home ownership. But if all of a sudden you can spark someone, if you can start to put this into Facebook ads, Instagram ads, just meeting people that you know in your spheres of influence, if you have a flyer that says, I've got up to $10,000 for you, and you've got your contact information on here, it's a nice way to start, letting people know time and time again, I'm the go-to realtor. I'm the realtor that's got $10,000 for you. Should we be talking about home ownership now or in the future, I'm the one to go to when you're ready. So again, I present this to you so that you can have this. We're going to define these three programs. I don't expect you to understand it by just looking at this flyer, but that I just want you to know we have the ability to co-brand it. So if somebody wants this co-branded flyer, and I'll ask you at the end, please put it into the chat box or send an email or a text to us and let us know that you want a co-branded flyer with your picture, your contact information on it. So let's get started with the presentation today. So we've got, let me just move this over a little bit. So we've got, what are the IHDA down payment assistance programs and how do they make homeownership easier for your clients? I'm the guest speaker today, Glen Marino, but Tony Marino is the branch manager from First Centennial Mortgage, and he will be the one that'll be in contact with your clients. A little bit about Tony. He is the branch manager for the Marino team in Naperville for First Centennial. He is a loan originator. He's licensed in Illinois, Colorado, and Florida. If you have clients that are moving from Illinois to Florida, from Illinois to Colorado, please contact us because we will be able to help and assist them in that transfer from Illinois to those other wonderful states. Tony specializes in getting people into home ownership using these down payment assistance programs, and he uses education to help people understand how they can become homeowners and own a part of the American dream. Well, the American dream is still alive and kicking. The homeownership is still, the American dream. People want to buy a home, and it can be an exciting, yet it can be an intimidating process. And so, I believe in the American dream, and I feel most people still do, but they're unsure as to whether it's achievable anymore with rising interest rates. This webinar is going to provide you with the information that will help your clients begin to dream of home ownership again. Why know about the IHDA program? And IHDA stands for the Illinois Housing Development Authority. Let's dispel a couple of myths. The state of Illinois may, in some people's minds, not be the most financially sound state. They're wondering whether or not these funds are going to always be available. What you have to understand is that the IHDA program, our proceeds, money, that is generated by selling revenue bonds. The key here is revenue bonds. That means that the proceeds are isolated, can only be used for these housing programs that we're going to talk about. So if you hear the state of Illinois is having difficulty making pension contributions or paying salaries or doing anything financially, it has nothing to do with this program. The program is totally funded by bonds that are sold out there to institutions, to investors, and the revenue proceeds, the revenue bond proceeds are used for this program. So again, why know about it? Well, because it's becoming a buyer's market, and we can get more buyers to the table to become homeowners, if we give them options, if we educate them. You want to become an educating realtor. There is a need or a want to become a homeowner. It's the American dream. However, there's too much misinformation about how much of a down payment do I need? Do I need 20% down? Do I need 15, 10% down? You're going to find out through these programs today that the minimum that they have to put into the IHDA program is only 1% of their own funds. Well, that opens up the eyes of a lot of people if all they got to do is put in 1% of their own funds. You want to set aside the individual's lack of confidence. They think that they are years away from owning a home. They've got enough money for that security deposit if they're renters, and for the first month's rent. And if that's like $1,500 for the security deposit and $1,500 for the first month's rent, they got $3,000. But they certainly don't have 5% down or 3%, 3.5% down if it's an FHA loan. So they just kind of, it's a self-fulfilling prophecy. They just say, I can't afford, I'm not there, I'm not ready. So they can't become homeowners. And when you educate them that they only need 1% of the purchase price, all of a sudden their eyes are open. They start dreaming of home ownership, and they start asking you, the educating realtor, please, your team, provide me with more. 50% of the renters think they can't afford the down payment. However, they have the financial means to maintain mortgage payments. What I mean by that is maintain mortgage payments. They have the ability to make rental payments. Rents are not inexpensive these days. I mean, I'm seeing rents anywhere from $1,500, $2,000. I've seen them up to $3,000 per month that people are renting houses because they believe they cannot purchase a single family residence. So it's up to us. It's up to you as a realtor to educate individuals on the financial assistance available to them, enhance the quality of their life, and help these individuals with wealth building and equity appreciation. What I mean there also is that those who own real estate versus being renters end up with a net worth 45 times greater if you become an owner of real estate and continue to be an owner of real estate throughout your lifetime versus someone who stays a renter. Who is IHDA good for? It's good for renters. It's good for existing homeowners, which again, stop there for a second. This is not a first-time home buyer program. So don't think, when you think you realtors who've got a customer database, if you've got a client that is already an existing homeowner, but they're not getting enough either equity out of a sale of a home, or they want to retain some of their own funds for accessorizing the new house, IHDA can be a good option for them. So this is for first-time home buyers and existing homeowners. Who is it good for? It's good for sons. It was good so far for 2 of my daughters. I got 3 daughters, and both of them have used these down payment assistance programs. Family members that dream of home ownership. That means aunts, uncles, brothers, sisters. If they're thinking of home ownership, but they're just not ready to, is it because they just haven't saved enough for the down payment or for the closing costs? They got the credit score. They're able to pass the credit test for a landlord. Well, then why aren't they thinking of home ownership if you can show them they can buy for as little as 1% of the purchase price? It's good for friends. It's good for anyone who thinks they can't buy a home because they did not save enough money. And it's good for anyone who thinks they can't afford, the housing payment. So what are the advantages of home ownership? Well, it's a place of your own versus renting is not a place of your own. Or living with parents is definitely not a place of your own. So, you're giving them the ability to have a place of their own. You're going to stabilize their housing costs versus rising rental costs. You're going to help them build equity, which builds wealth. We talked about that. They're going to have a greater net worth in the future. They get tax deductions on interest and real estate taxes that they pay. They can borrow against the equity that they build in their home or convert it to cash later when they retire. That's talking about a reverse mortgage. Many people that we talk to that are becoming 62 and older, especially with inflation these days, with rising costs, we've got, a lot of people that are sitting on homes free and clear. They can't spend the brick and mortar, but they certainly can. We can convert it into a monthly, like annuity payment to them of $1,000 a month for the rest of their life. And all of a sudden they're breathing much easier and they're smiling a lot more and they're enjoying life in their retirement years. And once again, homeowners have a 45% greater net worth than do renters. So buying a home is a huge step, but buying a home doesn't have to be that challenging. Perhaps all they're missing is the down payment. And maybe you, as that educating realtor, can show them how you have that missing piece of their puzzle. So what if you can help them with the missing down payment? Well, it helps an individual overcome a financial barrier to home ownership. It helps take away the negativity of, well, I can't afford, I can't be a homeowner right now. Show me a rental unit. But does it, the financial assistance from down payment assistance is typically used for down payment and for closing costs. Your team, meaning you, the realtor, and your loan officer can provide your clients with access to $6,000, $7,500, and $10,000. So why don't most people buy a home? Well, again, they feel they don't have enough money saved, so they, automatically say, I'm not ready to buy a home. Their credit may be not good enough. Maybe yes, maybe no, because you're going to see here, minimally they need a 640 credit score. No, they don't need a 780 score. They don't need a 700. They don't need a 680. They need 640. And if they're not at 640, your team here at First Centennial can then do what's called credit repair and get them to that point within a period of, say, 30 to 60 days, provided they take the action steps that are necessary to fix their credit. And again, why don't most people, buy a home? It's because they just don't think they can buy. They've got the defeatist attitude. So with knowledge of some exciting loan programs, get your clients dreaming again, dreaming of home ownership. Let's take a look at some of these exciting programs. Well, first off, if they're a veteran, they can get up to 100%, with a VA loan. If they're out in some of, I'm going to call it the far suburban areas, more the rural areas, there's 100% USDA loans. If they have very good credit, they can get 3% down and a 97% conforming loan. If they have, I'm going to say, moderate credit scores, they can get a 5% down with 95% a conventional loan. Here we have a standard FHA loan. They can go down to as low as 580 and they can get 96.5% financing. They can also, if they're buying a home and it's ideal, it's great location, it's great school district, it's got great transportation routes to get to and from work, but the house is bruised. They can get 96.5% of the purchase price and they can get 96.5% of the repairs to fix it up, what we call a buy and fix up loan. That's kind of been a very attractive loan for people that are buying a home. They're looking for a bargain. They get the bargain, and then they also get 96.5% to fix it up to make it their dream home. Here's what we're talking about today, though: the $6,000 Open Doors Forgivable Grant. And we're going to talk more about that in a second. But they only have to come up with 1% of the purchase price of their own funds. However, the $6,000, when you hear the word grant, that means it's being granted and they don't have to pay it back. It's a forgivable grant over 5 years. So kind of a great little program. And you're going to see also that if you and I think today's interest rates are high, because they're getting near 7%, this program, the $6,000 program, has rates still in the 5s. So that all of a sudden opens the eyes of many a buyer by going, oh my goodness, I've been looking at rates. The rates are, approaching 7%, in some cases over 7%, and you can give me a rate in the high 5s. I'm all in. This sounds like a great deal for me. The second program that we're going to be talking about today is the $7,500 zero interest loan with deferred payments for 30 years. Again, you only need 1% of your own funds. And again, I'm going to go through it a little more slowly in some of these upcoming slides, but let's talk real briefly about it. I call it a crazy great program. I wish this was around when I was buying houses. It's a zero interest loan. So I get $7,500. I don't have any interest on it. I don't have any payments on it for 30 years. So I get the money from my wonderful realtor and loan officer. I don't have any payments. I get to use it for my down payment and my closing costs. And the earlier of, when I resell the house or at 30 years from now, I have to pay back how much? There's no interest. I only have to pay back $7,500. So if I stay in this house for 10 years and then decide, well, no, my family has grown, I got more children, I need a bigger house, I'm going to sell this house and buy a bigger house. At that point in time, your attorney is going to ask for a payoff letter on the first mortgage, and they'll get a payoff letter from the state of Illinois, and the payoff letter will say you owe us back $7,500. You'll pay it back out of sales proceeds. I think it's a great program. I love that program because, again, it doesn't impact me on a monthly basis for all the years I live in the house, and I just have to give them back principal only after the many years I've lived in the house. And lastly, we're going to be talking about the $10,000 zero interest loan. However, it does have it does have monthly payments of principal only. Oh, they have to pay back the $10,000 over a 10-year period. The 10 years is 120 months, correct? So if you divide 120 into 10,000, it's $83.33. Well, that's pretty easy for most people to accomplish. So what I typically tell people is, hey, if you took out your significant other for a nice meal this weekend, glass of wine, nice meal, what would it cost you? And they say, Glenn, it depends on the restaurant. It could be $60, $80, $100. I said, if you give up one of those meals a month, I said, you'd have $83.33. If you can do that, I can give you $10,000 tomorrow. Would you be interested in looking at housing? They say, Glenn, it's a deal. Sounds great. Tell me more about how I can do this. So those are going to be the three programs we're going to be talking about. This is a chart on it. I think it'll be easier to understand as we look at some of the qualifications on the next slide. So here we are. The IHDA program it's available for first-time and non-first-time home buyers with income limitations and purchase price limitations. And we're going to look at that briefly, but round numbers, they have to make less than $125,000 a year. I don't know about you guys, but I know lots of people that make less than $125,000 a year, so they qualify. And we have to stop here for a real quick second and say, is that the household income? Meaning when you add the husband and the wife together, what they're making? Or is it the borrower? I mean, I've had many a client where, let's say, one of them is making $110,000 and the other one is making $90,000. Well, yeah, those two together, that's $200,000. You think, oh, they don't qualify. They make more than $125,000. However, what we do is we look at it and go, well, it's a borrower limitation, not a household limitation. So if we take the $110,000 person in that household and say, you qualify on your own. You can put your spouse on title, so both of you own it, but we're only going to use one of you for income purposes. And so 110 is less than 125, and they are now in their dream home with a big smile with $10,000 that you have provided for them. Another eligibility requirement is that it must be a 1 or a 2 unit single family residence that they live in. It cannot be an investment property. Now think about this, which has been kind of nice to see for some people. Some have used this to buy a 2 unit property. So let's just say, for sake of discussion, their monthly payment is $2,500 from the lender. But if the second unit is providing them with, pick a rent, $1,500 in rent. So $2,500 minus $1,500. So they've reduced their mortgage payment down to $1,000 a month. because they were able to purchase a 2-unit using this program. And again, you're going to see that the purchase price limits are right around $350,000 on a single family, and it's about 400. I've got the chart later, about 450,000 for a 2-unit. So again, on a single family, I would imagine most realtors, I mean, I'm sure your listings are for some greater than 350, but for those that are 350 or under, this would be a great note in your MLS remarks to say that you might be eligible, buyers, you might be eligible for up to $10,000 in down payment assistance if you buy this home. It might differentiate your listing from somebody else's listing when all of a sudden you're giving down payment assistance. Another eligibility is the borrower must occupy the property as their primary residence. There can be no non-occupant co-borrowers, which means non-occupant. It would be like me being, I'm not going to occupy my daughter's house, right? But if she needs financial assistance, I might volunteer to be a non-occupant, because I'm not occupying, co-borrower, then they can look at my credit, my income. But in this program, they are not allowed. On standard loans, standard conventionals, standard FHAs, yes, but not on the IDA programs. And in the eligibility for the IDA programs, you're going to get, your clients are going to get nothing but 30-year fixed rate loans. 30-year on VA loans, FHA loans, USDA, or conventional. So always think of IDA as being the second mortgage. The client still gets what's in their best interest as their first mortgage. If they're a veteran, we're going to look at a VA loan. If it's FHA, that is best for them, we're going to put them into an FHA loan. If it's a conventional, we're going to put them into conventional. IDA doesn't dictate what they choose for a first mortgage. However, IDA does dictate the interest rate that they will have on their first mortgage. And you'll see that in a little bit. Some of the other qualifications are, and we talked about, I'll show you the chart soon about the income and property limits that apply on these loans. But here's the credit score. I say there's only 2 green lights that people really need in order to qualify. One green light is a 640 or better credit score. It's 640 for FHA, USDA, VA, it's 640 for conventional. So green light number 1, do you have at least a 640 or better credit score? Great, green light, let's move forward. Now, does the borrower make less than $125,000? They do? Man, we got 2 green lights. It looks like we're moving forward toward getting them up to that $10,000. The other qualification is they can't have a debt to income ratio greater than 45%. What does that mean? That means the denominator is their gross income. We always qualify borrowers on gross, not net income. So whatever their gross income is. And then what we're saying is they can't have more debt, monthly debt, the housing payment, plus their minimum on credit cards, the minimum on student loans, the minimum on automobile loans, that when you add up all their monthly debt as a percent of their gross monthly income, it can't exceed 45%. Okay, so we're looking to do that. And if they exceed it, we're going to work with them on, hey, pay down this credit card. Hey, refinance the automobile. There's things that can be done to reduce that debt to income ratio. The other qualification is the borrower must contribute 1% of the purchase price. Well, that's kind of nice. On a $300,000 home, that's $3,000. On a $200,000 purchase, it's $2,000, or $1,000. Whichever is greater, or $1,000 from the buyer's own fund. So it's typically 1% of the purchase price. But if that's not at least $1,000, they've got to come up with $1,000 of their own funds. If they've got $3,000 in the bank for security deposit and first month's rent, they got $1,000, or they got 1% of the purchase price ready to go. You got to remember, from a renter's perspective, that when their lease is coming due, the landlord has the opportunity at the end of the 12 months to say, you know what, I'm not renewing your lease. You were a noisy tenant. You were late in making some of the payments. I didn't like you as a tenant. So they have to be able to be in a position to leave and go to another rental unit if they're not buying. So they've got that first month's rent and security deposit ready to go. And again, some renters also look at it and go, you know what? The neighborhood's getting I got small children. The neighborhood's getting too risky. There's too much crime on the streets in this neighborhood. I want to move. I want to get the kids into a safer neighborhood. I want to get them into a better school district. So they have that first month's rent and security deposit. And when they meet you with your flyer, co-branded, and you're telling them, I can get you up to $10,000 because you probably have about 640 or better credit score, and you probably make less than $125,000 a year. Green light, green light. Let's talk home ownership. Lastly, one of the qualifications is they must do home ownership counseling, which is we do that during the processing of the loan. We just give them a website to go to. They log in, they do the counseling. It provides them with a certificate, and we then put that into their file and send it to the underwriter. The interest rates on IHDA loans. I love this because, again, you're taking a variable away from the consumer and making them feel more confident, because there is only one interest rate that is offered each day by IHDA. It's not like, oh my God, I got to check. First Centennial said the rate was 7.25, or on that $6,000 grant program, the open doors, it was 5.875. I got to see if Bank of America or Wells Fargo or somebody else has a better rate. They can't. They don't. And you got to remember this too. Not every lender is an IHDA certified lender. We are certified with the state of Illinois. Unless you're a certified IHDA lender, they may not even have the program. I've heard many story out there that says, oh, from other lenders that talk to some of your clients, oh, you shouldn't go IHDA. It's so, it's a lot of paperwork, and it's going to delay your closing. Well, no, I always ask, do those lenders, by the way, that are saying those things even have the program? Maybe they're not certified, because there's only 4 little pieces of paper that are sent out at the same time as the application to your client. And our underwriters underwrite the file at the same time that they're underwriting the first mortgage. So there's no delay whatsoever in getting these people to closing. So the interest rate is the rate for the borrower's first mortgage. So if they're doing an FHA, the IHDA interest rate table, which I'll show you shortly, dictates what the FHA loan rate will be, conventional, VA, or USDA. So the interest rate that IHDA provides is the interest rate on their first mortgage. And that the IHDA portion, the $6,000, the $7,500, or the $10,000, is a second lien or a second mortgage on the property. With, remember, only the $10,000 program requires $83.33 per month. So again, the $6,000 program requires no payment. It's a grant. And it's forgivable over 5 years. So if they live in the home for 5 years, there is no repayment whatsoever. Remember, the $7,500 is a 0 interest loan with no interest, no payments for 30 years, or until you sell the house if it's before 30 years, which most people sell it before the 30 years. And lastly, the $10,000 is a 0 interest loan with principal payments of $83.33 a month. Great. So here's some of the interest rates. Some of the interest rates are, right, this was as of October the 12th. And the government, this is the FHA and the VA loans, and these are the conventional. But look at this one down here. This is the $6,000 forgivable grant. 5.875. I mean, if I were to offer someone today just a conventional loan with great credit, I couldn't get to 5.875. So this is probably the most popular down payment program right now, is this $6,000 forgivable grant at 5.875. This here is your $7,500 program. This here is your $10,000 program. So, in simple terms, it's either 7.25 right now, or it's 5.875. Here is your household income limits. Remember I said 125,000? Well, it's 125,040. If you're in Cook, Kane, Lake, McHenry, McLean, Will, or DuPage. If you're in Kendall, 136,920. So this probably covers a majority of the people that you deal with on a regular basis. And again, keep in the back of your mind, remember I said at the beginning, I'm talking about, you know, the IHDA flyer, getting it co-branded so you can start handing it out and letting people know you got 10,000. The other thing I want you to keep in the back of your mind as we go through this, should you be hosting a first-time homebuyer program? Meaning that I can be your guest speaker. We can do a first-time homebuyer or a homebuyer seminar. If you know 6 people or more, we'll put them on my Zoom and we will do this together. So again, if somebody is interested in doing a homebuyer seminar, put that into the chat box or text or email us and let us know that you want to do that. Lastly, here on this page, notice what the purchase price limits. Remember I said it's about $350 on a single family residence. So in DuPage, Cook, Kendall, all these collar counties, it's just under $350. And then remember I said round numbers $450 for the 2 units, and it's 447, $542. So those are your purchase limits, those are your income limits, and most of the people that I know of, you know, are making less than, at least the borrowers, less than 125,000. So let's look at this now about renting versus buying. Let's look at the 3 buckets of cash needed to close. Let's apply this. How does this all work when I'm talking to a client? And again, this can either be provided to you along with your co-branded flyer and you can staple it together, or you can contact Tony Marino and he can work this up for you. But here's a great example. I got it both at 200 and you're going to see one at 300. So here is, assuming a purchase price of 200,000, the down payment is 3.5%. Say they're going FHA. Let's say that they're using the $10,000 program because they can do 10, 7,500, or 6. The average closing costs on a purchase are $5,000, and whenever you use the IHDA funds, 10, 7,500, or 6, there's a 1% origination fee that IHDA charges. Okay, so let's now that those are the assumptions, let's go over to the rent. Let's assume that they're renting, their first month's rent is $1,500 and security deposit is $1,500. That's $3,000. They've got that in their bank account. They're ready to move if the landlord does not renew their lease, or they're ready to move if they say, I want to move into a safer neighborhood. So they've got $3,000, but they just don't maybe have the rest of what you're about to show them on the other side. On the purchase side, the down payment is 3.5%. Well, what is 3.5% of 200,000? It's $7,000. So bucket number 1, and I find it easier to talk to my clients as far as buckets. So bucket number 1 is down payment. It's $7,000, but you always have to ask, who pays that? Well, the borrower has to come up with 1% of the purchase price, because you guys told me that IHDA wants minimally 1% of the purchase price coming from the buyer's own funds. So 1% of 200,000 is $2,000. Okay, well, we got $10,000 in the IHDA bucket, so let's use 5,000 from IHDA. So 5 and 2 is $7,000. Put a check mark. We got all the money for the down payment bucket. Go to bucket number 2, closing costs. Who pays? The closing costs are the normal $5,000 plus the $2,000 origination fee. It's $7,000. Who pays it? Well, the borrower could. We would prefer that they not. So we used only 5 of the $10,000 from IHDA. And so we've got it still $5,000 remains in our IHDA bucket. So let's use it for closing costs. And so we only need 2,000 more. Well, let's assume that the realtor is a pretty doggone great realtor and that they negotiate for their client and have the seller provide a closing cost minimally of $2,000. That then means that 5 and 2 is 7. They've got all the money for the closing costs. Put a check mark. They got all the money they need for closing costs. So let's move on to bucket number 3, prepaids / escrows. Escrows for real estate taxes, escrows for homeowners insurance. And the beauty of all this is that in the state of Illinois, we pay our real estate taxes in arrears. What does that mean? It's 1 year behind. We're in the year 2022. We're paying 2021's real estate taxes. So here we are in October. Let's assume that we have a closing on October 31st. That's 10 months into 2022. That tax bill is not going to get paid until 2023. So what does the seller have to do at the closing of our client, the buyer? They have to give our client 10 months of real estate taxes as a credit. Because who lived in the house from January 1 of 2022 to October 31st of 2022? The seller. Seller gives our client a credit. The credit, the real estate tax credit, is always greater than whatever the lender is asking them to set up in the escrow for real estate taxes and homeowners insurance. So this bucket is a 0 because of the real estate tax credit. Quite honestly, it's a negative number, but I don't like it gets too confusing with negative numbers to clients. So I just tell them that that bucket is 0. So let's summarize in reverse. If bucket number 3 is 0 for escrows, bucket number 2 is how much is the borrower putting in that yellow? Nothing, because IHDA and the seller provided the funds. And how much is our client providing a bucket number 1, the down payment? Shows 2,000. So 2,000, 0 and 0 is 2,000. He could buy a $200,000 home for $2,000, or he can give $3,000 to his landlord for first month's rent and security deposit. If you provided this to your client, do you think he might just say, "Can you talk to me some more about this? This sounds really, really good. I thought I was going to be a renter, for the next several years, and you're showing me how I can become a homeowner." Here's the other cool question. What if the earnest money was equal to 1% of the purchase price? So let's say that you went down the road with them and you did the contract and you put in the contract that the earnest money was $2,000. Well, if you already gave the $2,000 up front with the offer, the cash at closing then would be 0 if he's using the IHDA program with the $10,000. Kind of a cool thing. It's really a fun discussion to have with your client when all of a sudden they're getting ready for closing and they say, "Well, how much money do I have to bring to closing?" And you tell them, "Well, it's 0. You gave $2,000 up front, and that was your minimum that you had to put into the contract." And again, what I like about those 3 buckets of cash, and again, it's an Excel spreadsheet that we can share with you, we can give to you guys, is it helps you in structuring a purchase offer. Do I need any funds? Do I need the seller to provide some closing cost credit? You'll see some more examples here as we move forward. So now let's look at a $300,000 purchase, not a 200, and let's assume that we're using a $6,000 grant. Remember, the grant program is a forgivable grant over 5 years should they live in the house. And by the way, what happens if they don't live in the house for 5 years? So they live in it for, 4 years. It just so happened that the family got bigger, they got more children, they needed a bigger house, so they decided to sell before the 5th year. So 4/5 has been already forgiven. So, approximately, and that's 80% of the 6,000. So let's just say, round numbers, about $4,800 was given. So they still have $1,200 that has not been forgiven. All that means is that when their attorney asks for a payoff letter on the first mortgage, the first mortgage lender will say you owe whatever the remaining balance is on the first mortgage, and the state of Illinois will say you still have a $1,200 balance on the grant that needs to be repaid back. You didn't stay for 5 years. So there's no penalty. The grant hasn't been totally forgiven and they have to pay it back out of sales proceeds. No big deal. So here we're going to do the $6,000 grant. So again, $300,000 minimum down payment, 3.5% using an FHA loan. $6,000 happens to be the IHDA down payment assistance. The closing costs are normally the $5,000, and the 1% origination fee is about close to $3,000. So on a $300,000 home, again, you realtors probably know better than I, the rents can be right around $3,000 a month, and the security deposit. So they've got about $6,000 sitting in the bank, to give to a landlord. Or they work with you, because bucket number 1, down payment, is 3.5%. What is 3.5% of 300,000? It's $10,500. Who pays it? We always have to ask, who pays? Well, again, we know that IHDA wants them to minimally put in 1% of the purchase price. So they're putting in $3,000 minimally. They're only they're only choosing of the 3 programs, 6 grants. So we're going to use all of the grant, all of the 6,000 for down payment. But they're still short. 3 and 6 is 9. They need 10.5. So they got to come up with another $1,500. So, okay, so far they're putting in $4,500 toward the bucket number 1. Bucket number 2, the 5,000 and the 2,895, that's 7,895 for the closing costs in bucket number 2. Who pays that? Well, the borrower could. IHDA can't because we're all out of money. We used the whole 6,000. But the seller, especially in today's marketplace, with it being a buyer's market, the realtor can negotiate for an additional $7,800 that would be applied toward, that the seller would give as a credit. And again, that can be one of 2 things. One, you go in with the offer asking them for a seller credit for closing costs, or what you end up doing is if they say no, we're not going to grant that. Let's say this is a $300,000 purchase that both buyer and seller have agreed that's the price, but you go back and you say, you know what, my client doesn't want to pay $300,000. My client wants to pay $308,000, not $308,000, provided that your client, your seller, will give an $8,000 credit toward closing costs. Well, 8,000 from 308,000 is 300,000. If they had agreed upon verbally before you, because again, who scratches, who creates the purchase offer? Well, it's you. You're representing the buyer. So before you ink it, you're doing a little bit of negotiating. You've already got the price agreed to, and so now what you're going to do is modify the price up 8,000. Again, this only works provided that you feel that they can get an appraisal for the $308,000. So let's assume that we're able to get the seller to provide us with $7,800 worth of closing cost credit. Our borrower would come up with $0. And once again, because of the real estate tax credit in the state of Illinois, our customer on bucket number 3 will have a 0 bucket for escrows. The closing costs will be 0 to our client, provided the seller gives a credit. And again, if he doesn't give the full amount, then the borrower may have to come up with, $1,000, $2,000, $3,000. And in bucket number 1, it's all of $3,000, $1,500, $4,500. So for $4,500 under that assumption, your client, our client, can purchase a $300,000 home, or then go rent it for $6,000. And again, once you show your client this worksheet, do you think they're going to want to continue to rent, especially if they have a 640 or better score, and especially if they happen to make less than $125,000? Methinks that they would probably be saying, please talk to me more about how I can purchase a home. So what is the housing payment if they agree that that's the route that they want to go? A $300,000 home. The loan amount's about $294,000. They're using the $6,000 grant. Remember, I showed you the rates. This is a great rate. You won't find this in today's marketplace unless you use the IHDA program. They get a 5.875 rate fixed for 30 years. So the principal and interest is about $1,700 with real estate taxes, homeowners, and PMI, and they're going to be paying approximately $2,600. Or they can be paying rent of $3,000 to a landlord and own nothing and not own an appreciating asset. So this assumes it's a 5.875 rate on a 30-year fixed rate FHA. But what if this also, just to make it fun and a little more spicy, what if it was a 2-flat that they were buying? Well, then you're going to subtract the rent that they're receiving on the other unit from the $2,599, and that's what their out-of-pocket will be for their mortgage payment each month. Kind of exciting. Let's do another one. Let's assume that was $6,000. Let's do the $10,000. It's not really a grant. It's a misprint there. It's a $10,000 zero interest loan. For those of you that have been, taking notes, paying attention, on the 10th, it's a zero interest loan with monthly principal only payments of $83.33, paying it back over 10 years. So again, $300,000, down payment 3.5, using the $10,000 program, and the average closing costs, between our $5,000 plus the origination fee of $3,000, that's $8,000. So again, they can come up with first month's rent, security deposit of $6,000, or they can go to bucket number 1. The down payment is $10,500. Okay, IHDA says, please come up with 1% of your own funds, and that's $3,000 on a $300,000 purchase. Cool. Then what we need is we need another $7,500. So IHDA is going to provide $7,500 because we got 10 grand, 10,000. So we use 7,500. 7,503 is 10.5. Put a check mark. We got all the money for bucket number 1. Cool. Go to bucket number 2, closing costs. They're about $8,000. The ordinary and customary costs plus this 1% origination fee. Okay, well, who, again, we always ask who pays. Well, the borrower could. We would prefer they not. So we still have IHDA still can come to the table because they still have $2,500 remaining from the $10,000. They only use $7,500 in bucket number 1, so they got $2,500. So now we need the seller, the realtor, to be that wonderful negotiator. Either get them to agree up front or, increase the purchase price and ask them for the counter to the increase in the purchase price is for them to provide a seller credit for closing costs of $5,500 in this example. $5,500 and $2,500 happens to be $8,000. We've got the borrower coming up with 0 as far as closing costs. And once again, the same logic applies to the escrows here. The real estate tax credit exceeds what the lender is going to want them to put aside for real estate taxes and homeowners. So 0 in the escrow, 0 for closing costs because IHDA and the seller are going to be providing the funds. And in bucket number 1, the down payment, the customer is coming up with $3,000. So for $3,000 using the $10,000 IHDA program, they can buy a $300,000 home, or they give $6,000 to the landlord and own nothing. I think when you show them this worksheet, and again, I used to verbalize this stuff to clients, and it's like going around in a circle, and the story gets so convoluted by the time it gets, if you're talking to the husband and now he's going to go home and try and verbalize it to the wife, or conversely, you're talking to the wife and she's going to tell the husband, it gets so mixed up. When you give them this worksheet and they see the numbers, now they can absorb it so much greater, so much better. And all of a sudden, now their eyes are open. They're dreaming of home ownership, and they're saying, I thirst for more. Please talk to me some more. Get your team involved with me. I want to see if I can qualify to buy a $300,000 home for $3,000. Now, remember, the rate is 5.875 only on the $6,000 programs. So here's what the payment would be on a $300,000 home, a loan of $294 with a rate of 7.25. The principal and interest is $2,009. They got, remember, the down payment assistance program on the $10,000. They have $83.33 a month to pay back principal only. They got taxes, homeowners, and they got PMI. So their payment's about $29.50 per month versus paying $3,000 for rent. Even if it was $3,000 for their payment, they still should want to not pay rent to a landlord and own nothing versus building equity in an appreciating asset, having stability, having a place of their own. This assumes a 7.25 interest rate. And again, envision what if this was a 2 flat and they're getting $1,500 a month in the second unit, subtract that from the $29.50, and all of a sudden their payment is like $14.50 a month. And they're saying, I love you, you're wonderful, thanks for helping me, see how I could become a homeowner. So let's summarize the 3 buckets of cash. Bucket number 1 is down payment. Who pays it? You, meaning the borrower and or IHDA, can pay for it. And the conventional loan with high credit, it's 3%. A conventional loan with lower credit, it's down to 620, it's 5% down. On an FHA loan, the down payment is 3.5%, or if you use IHDA, it's 1% is your share if you use the IHDA down payment assistance program of $10,000, $7,500, or $6,000. Bucket number 2, the closing costs. Again, you're always asking who pays. The borrower can always pay any of these, but they don't have to. It's always approximately $5,000 for typical, customary, ordinary closing costs on most purchase transactions, plus an additional 1% origination fee when you use IHDA. Okay, so who pays it? Well, you, the borrower, you can pay it. We prefer you not to. IHDA can pay, and or we can combine it with the realtor negotiating that the seller pay. The seller can outright agree when you make an offer to them, and if they don't agree to pay the closing costs, then what you can do is you can ask them, once you've agreed, once you got the table of expectations set, buyer and seller have negotiated back and forth, they've agreed on $300,000, you can ask them to pay $5,000 more for the seller's home, provided the seller pays $5,000 of your customers, your buyer's closing costs. Your lender can also pay some of the closing costs if they're willing, if the customer is willing to accept a higher interest rate, but it's only on non-IHDA loans. We're focusing today on IHDA loans, so we're not going to talk about the lender helping to pay for some of the closing costs. So how much of your own funds were used for the closing costs? Zero is the answer on the previous slide. Bucket number 3, prepaids and escrows. You're asking who pays. Remember, on prepaid interest, you pay interest from the date of the closing to the end of the month. Date of closing to the end of the month. That's why most realtors set up the closings for their purchases towards the end of the month. If it is on the last day of the month, it's 1 day's worth of interest. The day of the closing was the end of the month. To the end of the month is 1 day. So, I mean, the closer you get to the end of the month, the less a customer has to come up with cash at closing. As far as escrows, they're going to set aside 2 months of homeowners insurance. They're going to go anywhere from 2 to 8 months of real estate taxes, depending on the month they close in. And in Illinois, because we pay real estate taxes in arrears, the seller credit will always be greater than what the lender is asking them to set up at the closing. So this bucket is always 0 except for new construction. The reason I say except for new construction, because in new construction, the previous year's taxes are for dirt. So, I mean, there's not a big credit for dirt. I mean, if they're paying $100, $200 for real estate taxes on dirt, the credit isn't going to be that meaningful. But again, I'd say 99% of our work is on existing homes, not on new construction. So the third bucket, as far as escrows, it's typically 0 to the customer. So the summarization here about the 3 buckets of cash needed at closing. Bucket 1, down payment, 1% of the purchase price if we structure it right. Bucket number 2, the closing costs, it's 0 with IHDA if you have IHDA and the seller paying the closing costs. And bucket number 3 is 0 with the seller credit for real estate taxes. So what are you waiting for? Take action. Now that we've reviewed how little cash is needed, what are you waiting for as far as getting the word out? One of the words is, do you know 6 people? I'll bet any realtor knows 6 or more people. I'm willing to be your guest speaker. You host a home buyer seminar. I'll coordinate that with you. You'll introduce me. We'll do the invitation through my Zoom. You don't have to go out and buy Zoom or anything. And what we'll do is 6, 10, however many people you want to invite, we'll get them there and we'll see if they would like to take that next step with you in becoming a homeowner. Don't wait, get yourself committed to working with Tony Marino, because again, he specializes in these. This is his phone number. This is his email address, t.marino@gofcm.com. And you should also download FCM Express. Go to your Play Store, go to your App Store, and this will allow you to share this app with your clients. And they can start getting themselves pre-approved, free of charge, by you just sharing this app with them. What I like about it, again, what I find is a little bit of a dysfunction in our business between, say, lenders and realtors, is that if a realtor finds a client that does want to move forward, that is interested in seeing if they would qualify not only to buy a home, to see if they qualify to get the down payment assistance, then they say, well, here, call a member of my team, call Tony Marino. Well, they call Tony, and Tony happens to be on a call like this with me, and he's not available for the next hour. So the person has to leave a message. Tony gets back to his desk and he then starts returning phone calls, and he calls back to your client, and the client's either out to lunch or is in a meeting. And so Tony has to leave. So they're leaving messages back and forth. Wouldn't it be great if you got somebody who's excited about becoming a homeowner, and all you have to do is take out your phone, press FCM Express. It says, do you want to fill out a loan application or do you want to share this? Well, you don't want to fill out a loan application. You're the realtor. You want to share it with your client. When you click share, it asks what's their phone number. You put in their phone number, you hit send. You've sent a text message. He gives them the link to the online application. They get immediate gratification. There's no leaving messages, no phone tag back and forth. again, you're using technology to its finest. Get them satisfaction immediately. So again, what you could do is, all this sounds good. So what are you waiting for? You could put this as a post in your Facebook, in your Instagram, in your TikTok, wherever you happen to be doing social media. Buy a home for only 1% of the purchase price. Amazing. A $200,000 home could be purchased for as little as $2,000. Then it says down here, click this link and find out how. And we always help you with a landing page. If you guys don't have landing page, free landing pages, you contact Tony, and he'll get you in contact with me, and we will get you a free landing page that looks like this. Congratulations, you're on your way toward home ownership. I never want to put a post in Facebook, an ad in Facebook, without giving them the ability to contact me. They like it. I don't want them to just like it and think, oh, this is fantastic. I want them to contact me. So I say, find out if you qualify for up to $10,000 in down payment assistance. Buy a home for as little as 1% of the purchase price. Amazing. It's easy to get started. Fill out the information below and I'll call you. What's your name? What's your email? What's your phone number? Click submit. When they hit submit, you know what it does? It goes to your email and it goes to Tony's email. So both of you are on your way toward talking to somebody who thinks that down payment assistance is pretty good. So shout it out in your social media. And if you don't have a landing page, you contact us and we'll create a landing page with you. Probably takes 15 minutes to create the landing page, and it's free to you. Are there any questions? And before I ask for questions, because I'll ask you to unmute yourself, I just want to remind you of some of the Realtor resources that we've either talked about or can talk about. One, who wants the IHDA co-branded flyer? We started out this conversation, this webinar today, showing you the co-branded with Jay Kiltz. If someone wants that for themselves, for handing out to future clients, please either put it in the chat box or contact Tony at t.marino@gofcm.com. Tony can also be reached at 847 area code 804-1059. Another question is, who wants to present a home buyer seminar? I said, I would be your guest speaker. You don't have to necessarily do all the speaking. I would want you to be the host. I would want to be your guest. I want you to welcome the people because they're your clients. Welcome them. Talk a little bit about the real estate market as you see it today. And then let's get into how we can help make them. I already have a different PowerPoint that will take about 45 minutes of presentation, and then we open it up for question and answers. If you'd like to do that, put that in the chat box or let Tony know that you would like to do a home buyer seminar. Another resource, number 3, is who wants the FCM Express app? Remember I said that they can get started immediately because you can share that app with your clients. What's even greater is Tony can get your picture, your contact information on the app. So it doesn't come from First Centennial. It comes from you. It has your picture, your contact information. And so again, it's a free app to you from us. Take advantage of it. It has a lot more on it. They can calculate mortgage payments when you're taking them around in a car and you're showing them a $225,000 home with real estate taxes, a $215,000 home, a $250,000 home. And you know what their question always is what's the monthly payment on this house? And with the FCM Express app, they can be calculating that while you're driving them to their next home. There's also something called the Lock and Shop program. With the Federal Reserve still increasing interest rates, if you have a client that would like to lock in an interest rate for 90 days, they do not have to be under contract. So they don't have to have an address. But if they say, you know what, I don't want to pay, I want to become a homeowner, but I don't want to wait 60, 90 days before we go to contract. I want to lock in today's interest rates. You can lock it, then go shopping with them. You lock it for up to 90 days. After 60 days, which means there's only 30 days left on the lock, they must be under contract. So it's a 90-day lock, but they must be under contract at the 30th remaining day. And there is no cost to this. There's no fee to this. So again, take advantage of it. The hybrid closing, number 5, is, do you want a 15-minute closing for the buyer or do you want an hour closing? What I mean by that is we send out the morning of the closing, all the closing documents that don't need to be notarized to your client with the mouse and with electronic signatures, boom, boom, boom. They sign majority of all the closing documents. When they get to the closing with you at the title company or at the attorney's office, there's only the note, the mortgage documents that need to be notarized. They've got maybe a handful of documents. If it takes 15 minutes, I'd be shocked. And from there, they're done on the buyer side. The seller side is rather quick. So if you're looking for quick, easy closings and for your clients to go, man, this was great. I didn't have to waste a half a day at a title company for a closing. Work with Tony on hybrid closings. We also have flyers on it. We could co-brand it with you on there, and we'd be more than happy for you to be handing these out to your clients, saying my team does closings so much quicker than others. You'll be done with the buyer side within 15 minutes. Last but not least, Sure to Close program. The Sure to Close program is a guarantee. We will not only electronically run your client's application through, say, Fannie Mae's computer, FHA's computer, and we'll get an electronic or automated underwriting decision. We have the file underwritten by a human being underwriter. And it is guaranteed that they will go to closing unless there's a change in the property. When the appraiser goes out, if all of a sudden, the foundation is cracked or there's a significant degradation in the property, or if all of a sudden the client, between the time that we give the Sure to Close, they go bankrupt, if there's a change in their financial condition, then we would have to opt out of the Sure to Close. But if their credit remains the same and the property doesn't have any issues with it, we are guaranteeing that they will go to closing. So now they can be more competitive. They don't even have to put in to the contract. You don't have to put in the contract that it's subject to financing. You can do it as if it's a cash offer, and we guarantee the earnest money up to $10,000. So if they put in it's a cash offer and they give a earnest money of $5,000, $7,000, $8,000, as long as it's $10,000 or under, we guarantee that they will not lose that, or First Centennial pays back that earnest money. Kind of a cool program. So if you want any of those in flyer form, if you want any of those in a co-branded format, please let Tony know. He's at 847-804-1059 or t.marino@gofcm.com. So I will open it up for questions to see if anybody has any, or I'm going to wish you guys a great day. So if anybody has a question, please unmute yourself.
Hi, Glenn, this is Ben.
Hi, Ben.
I'm the assistant over here. Just wanted to let you guys know that when we do the co-branding, we're going to probably ask you for some information. We're going to probably need your picture, and then what your business card basically reflects. So that's the only thing I'm interjecting there.
And let me see if there's anything in. Okay, let's see if there's anything in the chat box. There's 8 of them. Okay. Christine says she'd be interested in a co-branded flyer. Great, we can do that. Veronica wants a flyer. Carol wants a flyer. Stella. Thank you, Mr. Glenn. Great info. You're very welcome, Stella. Victor Jones, 1% of loan amount. Yes, not of purchase price. Correct. Marilyn, good morning. I would like to have a co-branded flyer. Not a problem, Marilyn. For all those that are in the chat box that want the co-branded flyer, that'll get into Ben's hands and Tony's hands, and they'll first send you out an email saying that thanking you for being here, but they'll also say, great, we want to get started on the co-branded flyer, and then they'll ask you for your contact information. Most of you have a headshot, because you've got it on your business cards. You got a JPEG headshot, and you probably have a logo in a JPEG form from your company. Just that'll be on the instructions in the email. You'll send those back into Ben, and then they will send those out to you for your use. Any other questions before I let you go? If not, you guys have been great. Appreciate it. If you have any questions, please contact Tony, and we'll be back to you next month with another exciting class. Have a great day, everybody. Thanks for being here.